Welcome to another episode of the All Tense Podcast. I'm your co-host, Josh West. With me, as always, Clay Harris. And today, Clay, we're closing out our Outside the Guide series on financial statements. In the first episode, we covered off on the income statement, what most people call the P&L. Episode 2, we covered off on the cash flow statement, and both of those statements cover a period of time. And today, we're rounding it out with the balance sheet. The main difference there being this is just a moment in time and a snapshot. Tell them what's up with the balance sheet, Clay.
But it's literally like a snapshot of tell me what's true right now. How much do I got? How much do I owe? And we can derive a bunch of good stuff. Assets and liabilities are the actual words that people use. That's what it's showing you is like. And so this is everything from like liquid assets, like what's in your checking account, to probably putting a value on your hard assets on there, your inventory. Like there's like things that, right? Things that might not be immediately liquid. There might be some long-term assets on there that it's probably where real estate goes. Inventory probably goes in a short-term type of asset. And then your liabilities. Who do you owe what, right? Interestingly, just to call back to our previous episode around cash flow statement, AR is an asset. The money that people owe you is an asset. AP, the money that you owe people, is a liability. There's probably other liabilities, like things like mortgages go there. We generally like work to get to those in equilibrium, but if you have a lot more assets than you do liabilities, that's your equity. And so this all shows up on the balance sheet, right? And the numbers are important because you want to keep an eye on them. But I don't know where you want to go next, Josh. But the thing about the balance sheet that I think is most functional for most of our listeners who own and operate businesses is understanding the ratios there, right? Kind of understanding key different parts of the balance sheet and understand how they work with each other to indicate health. Does that make sense?
Yeah, and before we get completely into those details, for me, just that high level, as you talked about, some of the very important words when we're talking about the balance sheet is those assets and liabilities and that snapshot in time. The question that we're answering here is, what do I own and what do I owe? And the difference between those things is shareholder equity. And I think you mentioned how liquid or illiquid an asset can be. Obviously, cash being the most liquid, probably property being the most illiquid of those assets. And then the other thing that I think is important is that a lot of times you'll hear people say current liabilities and current assets. And to make it easy, when we say current, we're talking about within the next 12 months. And anything beyond that is more long-term. So, for example, if you've got a mortgage on your business building, what you owe on that loan in the next 12 months is a current liability. And then anything beyond that is separately, and it's further down the sheet. And I think the first, insight that we can derive that a lot of people find to be important from the balance sheet is when we're talking about just the current assets minus the current liabilities is what many people refer to as working capital. So in this 12-month period, how much working capital do I have?
Yeah, and this is like working capital is just a balance sheet calculation. If you're going to the bank, they're going to ask you a bunch of ratio questions, and these all come from the balance sheet. So, so this is like to your point in our first episode, we're talking about income statement where it's like using the right words. When you hear words, ratios, working capital, those sorts of things, those aren't people just asking like working capital isn't how much money you have in your checking account. Like to Josh's point, it's like how much do you have in your checking account and how much do you owe people in the next year, right? Like let's be thoughtful about it. Like, and that's the sort of like kind of insight that I think people miss with this is why we're doing this series, is because like they look at their income statement, they're like, oh, I got we're profitable. They look at a cash flow statement. They don't. It's intimidating, and most of my clients probably don't even pay much attention to a cash flow statement. They probably look at a balance sheet and they're like, "Look how much money I got in my checking account." And the issue isn't that they don't owe other people money; it's that they probably aren't keeping track of them correctly. And so, like, this is what, like, I feel like. Tell me if you think this is crazy, but I feel like everybody kind of gets or 99% of my clients or people that I talk to kind of get the importance of understanding income and expenses and those sorts of things. And they have a chart of accounts and they're doing a good job of reconciliation every month, which is leading to a pretty good income statement, right? Cash flow statement. I'm not sure anybody's paying that much attention to it. Balance sheet, my guess is that it's used primarily as like a check the box type thing, and they aren't really looking at it. And I'm not sure they're doing a good job of understanding.
Well, and
looking into the future of liabilities and those sorts of things. You know what I'm saying?
And the other thing is they may be using it to answer the wrong question because, if you say, well, I looked at the balance sheet and I've got more assets than liabilities. And so I've got equity. So that's how much my company's worth. That is not the question we're answering. And that is not what your company is worth and not what it could be sold for today. Again, this is about what you own and what you owe. And specifically when we talk about current liabilities and assets, here again, just as, we talked in a prior episode, how you could have a profitable business that's also in a cash flow crunch and could become insolvent. Similarly here, you can be looking at that statement and saying, oh, look, see, I've got equity. But also, if you look and your liabilities in the next 12 months are greater than the assets that you've got an issue. So even just within that sheet, if you're looking at it to answer the right questions that it actually does answer, it can give you some other insights and keep you from hitting an iceberg down the road and alert you to the fact that you've got another issue in the business that you need to solve.
And my guess would be that our listeners are like, I would know that. That's fine. This isn't, I hope that that's true. That like you kind of have an understanding of the money that you owe and how much money you got and how the business generates cash. The other like leverage point of the way to use the balance sheet is to also understand the health of the company in relative to others, right? This is why when you go to apply for a loan from the bank, they ask you about these like debt coverage ratios and all these sorts of things, not much differently than when you do a home loan. They want to understand how the business health is, and they use ratios of different things on the balance sheet to talk about that. Things like like you mentioned already, the current ratio, right? Debt to equity, equity to assets, all these things are coming off of the balance sheet to understand your ability to pay for the future. And we're not here simply to answer yes or no. We're here to understand like with what level of confidence. This is why the bank, a lot of times when you go to the bank as a business and ask for money, they're going to say you have to maintain a ratio of 2-to-1 or 3-to-1, kind of depending on, what I'm saying, of like how much equity to debt you have. You know what I'm saying, right? And depending on how the business is financed, you might be able to compare that to other people in your industry and understand their ratios and understand like what they're doing to drive up equity and drive down debt, or like make assets grow out, the growth of assets outgrow the or at least outpace liabilities. You know what I'm saying? Like, so it's not just to click a thing and understand the equity of the business. And man, I hope not many of our listeners would print that report and be like, that's what it's worth, right? Because my grandfather used to tell me all the time, I'd go to the baseball card store and bring home a Michael Jordan. I'd be like, it's worth $100. He'd be like, it's worth what people will pay you for it. And it doesn't matter what that book says it's worth. Anyway, but to use it to drive performance, this is how we understand things like we have to figure out how to raise money cheaper, or we figure out how to increase AR or decrease AR, or maybe instead of like paying our vendors on net 40, can we get them to net 50? Like, how can we say all these sorts of things? Impact the cash flow statement also have a pretty darn big impact on the balance sheet as well. I'm trying to figure out, like, if we were a listener, like, what's the functional way other than looking at ratios? Every balance sheet I've ever looked at has a bunch of numbers on it, but then also at the bottom of it or on the side of it just has the ratios, and we spend most of our time looking at ratios, right? And part of that's because we had some financing partners at my old business, but like, balance sheet matters to me. The numbers on the balance sheet show up on the beginning and end of the cash flow statement, which is where I'm making a bunch of decisions around cash.
Mm-hmm.
And the balance sheet is more about ratios and making sure we're keeping up our obligations to our lenders, making sure that we aren't feeling upside down on like current ratio. The thing tells us whether or not we can pay. I want to give our listeners like some functional advice. You know what I'm saying?
Yeah, there's that. And then, the other thing is, if you've got a CPA, they're going to follow GAAP, and, they're going to keep things consistent. If this is something you're trying to do on your own, then, if you just read through it, there are some pitfalls that you could also fall into. So, for example, when we talk about fixed assets, let's say you bought a building. Let's say you bought a building 10, 15 years ago, and it's appreciated in value, and you generally know that. You're like, it's worth that, right? The reason why you would not update that and you would keep it consistent at the amount that you bought it at is for multiple reasons. One, in a prior episode, we talked about the necessity for maintaining consistency across the statement, so it's easy for us to compare periods of time.
Mm-hmm.
So if we've bought that building and we bought it for $5 million and we think it's worth $15 million now, you may want to say, well, I want to update that on the sheet because it's an asset, right? And if I ever sold it, I could sell it for that. But that introduces bias and volatility. Then, we can't easily compare apples to apples moving forward. And also, when it comes to accounting, we're really relying on consistency to the point where if you had 10 different CPAs generate that document for you, they would all reach the same conclusion. And so when you bought that property 10, 15 years ago, we've got that on record. That's verifiable. What's not now is, well, we'd have to get an appraisal. Well, whose appraisal? Who's giving us all this information now, right? It's introducing all this volatility that we don't want. Know that, and this is exactly why when you look at that shareholder's equity also on the balance sheet, you've got to resist the temptation to fudge the number that way or change it so that that goes up, because again, that's not the question that we're answering. Trust that, yes, accounting is related to valuation, and should you ever go to sell that property on its own or as part of the entire business, valuation will take care of that, and you will realize those gains at that time. But we're not updating it on the sheet because this is not what that sheet's about. So I can't stress enough that shareholder equity is not what your company is worth and not what it could sell for today. Just like your grandfather pointed out, value is determined by what the market will bear. So just some practical ways to keep consistency across all the statements.
Did we say the equation earlier that assets equal? I think I might have said it, but assets equals liability plus equity, right?
Yeah, because we go from, assets minus liabilities equal equity. And then a lot of times I think the way that is reconciled is then it's assets equal liabilities plus equity. And
right. And
when we adjust things within the sheet, most of the time they have a commensurate way of dealing with each other depending on what we are, so the sheet stays in balance. As we become more profitable, that's when that equity goes up if we've got retained earnings that come into there. But a lot of times what's happening is we're changing something on the liability side or the asset side, or it's even changing within that. So, if we've used cash for something, then like, how did that change? And so that comes into that interplay and connection amongst them. It's almost impossible to update one of these statements without
Right.
it having a commensurate effect on the others.
I think it's worth reiterating. One, we're not accountants. You should talk to someone that you know and trust to make sure that these are accurate and you're using them correctly in your business. Hopefully our episodes helped you figure out some questions to ask, but hopefully you didn't say like, I'm definitely doing that. Go talk to someone else before you make any decisions. The second thing is these are tools to manage the business. These are tools to have deeper understanding of what's working, what isn't. These are not outcomes, right? Like these are just like, they're representing what happened. They're all those sorts of things. But if you're managing only to these things, it's just like any other tool in your business. If you're not going to use the word manipulating, but if you're trying to make the balance sheet say something, you're probably missing the important stuff. If you make people happy, if you deliver a great service, sell it at a fair price, and keep them coming back and wanting more, you do a good job of getting work, do a good job of doing work, and do a good job of getting paid, those things will be reflected here. We don't want to change the behavior to make these things look better. We want to use these things to drive the behavior of better selling, better fulfillment, better getting paid and paying people. You know what I'm saying? And I think
that's the nugget to end the series, right? I think that is the most important thing that got said in all of this, is that no, we're not trying to manipulate these things. These things are telling us how we did, and we're making decisions about making our actions better within the business to run a better business. They're just simply tools.
Cool. Well, I'm going to wrap us up then. My name is Clay. His name is Josh. We're EOS Implementers. I'm in North Carolina. He's in Arizona. But we'd love to talk to you no matter where you are. I don't speak any other languages. So, like, do you, Josh?
I don't, but hey, we'll figure it out.
We'll figure it out. We got Google Translate.
Mm-hmm.
Yeah, I got Apple AirPods. Anyway, all right. We'd love to talk to you. The easiest way to connect with us is probably on LinkedIn. We'd love to see you there. In the meantime, for the podcast, like, share, rate, do all the things that you do with podcasts that you love. Share with someone who you think could benefit from this. And coming up next, we're going to continue this series, but instead of me and Josh just kind of pontificating about financial reports, we're going to talk to some experts. So we have a couple different, I think, CPAs coming on board to talk about their experiences working with business owners, about pitfalls to avoid, things that they see that work really well. So please stay tuned. Those will be coming out in the next week or two, and we can't wait to talk to you then. So thanks, everybody. Bye, Josh. Good job.
Bye.